Chelsea, I hand the mic over to you.
Okay, so I'm going to try to share my screen and make sure everybody can see it. All right, it tells me that you guys can see it. Will, can you see it?
Yep.
Okay, perfect.
Yep, we're good.
So thank you again for having me and giving me an opportunity to add some more color into this topic. It's probably the most common conversation that I have on strategy calls with applicants to the lab. It's also probably one of the top reasons I don't extend an invitation to someone to join, because my primary goal in our strategy calls is to make sure that acquisition entrepreneurship is actually going to allow you to reach the objectives that you're trying to reach. And so figuring out your target level of SDE is kind of critical. And so I think I welcomed the opportunity when Will asked me if I would be willing to do office hours on the topic, to come and kind of break it down a little bit for you guys. I just want to get started very, very briefly, kind of laying the foundation, because what we do in the lab, and Walker and Dybel, the author of Buy Then Build, and my strategy is there's a little bit of a uniqueness there, that we think that the most important component of your search is really around understanding your unique value proposition. It is probably one of the biggest reasons I felt comfortable kind of throwing my career away, as everyone said, to build the lab for Walker. But as a business psychologist or an IO psychologist, one of the most common challenges that I saw in transactions was that there wasn't enough time truly understanding yourself as a buyer and the entity that you're buying. And so when you understand your value proposition, it really becomes your North Star, and guides everything that you do when you're looking at listings, right? It kind of becomes your lens that you view things through. When I say your value proposition, I'm referring to kind of all of the knowledge and skills that you've accumulated throughout your career, all of the achievements that you may be able to replicate in an acquisition that you're making. Again, I'm an industrial organizational psychologist, or a business psychologist for simpler terms. And so I always tell people to think about businesses as a puzzle, right? They're kind of like unique organisms, right? They have all of their uniquenesses that make them who they are. And so you need to understand kind of the landscape of that puzzle. But the important piece is that you understand your own piece, right? What your puzzle piece looks like, so that when you're looking at a listing or looking at a business, you understand if you fit. And so just to briefly kind of explain this, because it really is the foundation of understanding how much money you want to spend and how much money you need to make. The reason why it's important is, think about Bob, right? I always use Bob as an example, but Bob is a digital marketer, and he is looking to acquire a business, like a service business that's outdated. They haven't really done any hard sales, much like the kind of companies that Walker talks about in the book. And so he is going to be implementing growth strategies tied to automations, ads, marketing outreach. And so if he was looking at a home services business that hasn't done that, that's going to be a perfect fit for him, right? But if he looks at a manufacturing company that needs operational efficiencies and somebody to come in and help with like safety mechanisms, probably not the best fit for him, right? And so that's your value proposition as a buyer. I'm not saying that Bob can't buy either of those companies. He totally can. You could buy a business tomorrow if you so chose. I wouldn't advise it, but it's doable. But what's important is that you buy the business that needs you. So Bob is going to be much more successful buying that service business that needs everything that he's offering than the manufacturing company. And the reason I bring it up here is because what Bob is bringing to the table is expensive. Right? Ads and marketing strategies are expensive to fund, and you need to be thinking about your growth strategies when you're determining how much SDE you need, because the SDE number is going to be funding your growth strategies. I just saw, I don't want to hang up on this too long because I really do want to keep this to 20 minutes so we have time for your questions, but there was a conversation that just happened in our free Facebook group yesterday, where a gentleman shared when Walker posted this webinar in that group. Somebody commented, like, I closed on a business and this was my biggest mistake, is I didn't forecast enough for how much my growth strategies were going to take. And then I ended up having to take a massive pay cut because I had to put all that money into the growth strategies. And so that's why I always have this conversation on strategy calls, is because I agreed to throw my career away to help people buy businesses. I wanted to help people, right? And so I don't want to help people buy businesses and screw themselves over. And so I want to make sure that anybody we let into the lab can get what they need to get through acquisition entrepreneurship. So the other value of the value proposition is, number one, it helps you figure. Most important, in my opinion, is it actually helps convince lenders of your bankability. And so you need to be able to convince brokers, sellers, and lenders why you're the right buyer for a business. And this value proposition is what's critical. Once you understand your value proposition, then it's time to draft your target statement. Many of you will likely be familiar with this if you've read the Buy Then Build a book. The challenge, and I'm not going to talk about this in any great detail, but I just wanted to highlight the SDE range here. So what I find is everybody will read the book and they'll draft their target statement, but that SDE range that they supply is very uninformed because there's not a lot of information out there about the dynamics of figuring out how to determine what your SDE range needs to be. And so that's why I wanted to have this call. And so there are a lot of components that go into it. I'm going to try my best to break it down piece by piece, but I do, and I will say this several times probably on this call, I want to caveat it all with, it is the Wild West, right? Every lender is going to probably do and say something different. Every business is going to need something different, and every buyer is going to need something different. So I'm going to do my absolute best to give you guide rails to operate in. But please know that if you talk to somebody and they tell you something different, they're not wrong. It's probably how they operate. And so I just want to caveat that. But this is kind of like back of the napkin math for, building out financial models. And so the first thing I want to talk about are that these are some of the most common things I hear on strategy calls with applicants. And most of you have said probably at least one of these things. Some of you may have said all of these things. But the most common is, I don't want to buy a job, right? Or I want to work on the business, not in the business. And what this says to me is different from what the person typically says next. And so the person typically says next that they're looking for something that they can operate as close to an absolute. And I'll push back on that, because what they're actually saying to me is they want to operate from a strategy perspective. They want to set strategy. They want to work on scaling the business. They want to do growth initiatives. They want to function in more of an executive capacity. Absentee has a very specific meaning in this market. And you have to be careful, because if you're looking to use SBA financing, they will not fund you if you are talking about being an absentee owner. They don't want to give you $5 million and then you're going to be like, I'm out, which is actually what an absentee owner does, right? They fund something and then they tap out, and they lead all of the operations to the people that are operating the business. And that's not what you're saying typically. As a buyer, you're typically saying, I don't want to be the day-to-day operator. I want to lead the business towards growth. The second thing that I hear a lot is this other piece around, I want to buy a smaller company first. It's almost like I want to dip my toes in the water of acquisition entrepreneurship. The challenge there, in my opinion, is that there is a little bit of cognitive dissonance when it comes to what size business you should be buying, right? Some people will think that smaller businesses are less risk, and this is what I refer to as the size fallacy. And I totally made this stuff up, guys. So if you Google this, you're not going to find anything. This is just the best way I could explain it, right? So there's a fallacy to the thought process of buying a smaller company being lower risk, right? Because a smaller company is typically going to be owned and operated by a single individual. They're often going to be working a lot of hours. There's not going to be a ton of infrastructure in place. Sometimes there'll be some employees, but most often what I'm seeing are contractors, right? They rely on contractors, sometimes overseas contractors. And there's less financial risk in your initial down payment and potentially like the loan size or the guarantee that you're signing. However, there is more like execution risk, for lack of better words, because of the fact that there's a higher likelihood that business is going to fail, just inherently based on research about what we know about business, because of where it is in the life cycle, right? And so the other piece that one of our advisors said on a call that was, and I won't ever say it exactly how he said it because it was pretty beautiful the way he said it, but basically, if you make a $10,000 error in a small business like this, it could be catastrophic, right? If you have $100,000 of SDE you're working with and you make a $10,000 error, that's a big dent in your business, right? So let's pivot to a bigger company. So a larger company is going to typically have an owner that's functioning in a more of an executive role. right? They, in many cases, will have worked themselves out of an operator role and will be relying on an operator. There'll be more mature infrastructure in place. Typically, they'll have employees. While there is more financial risk, like I'm not here to downplay, like buying a business is not a get rich quick scheme. It is not something that you can do that's low risk. It is high risk. Buying a company is high risk and high impact, which can be both positive and negative. But while you may be signing a guarantee or putting more money up front, there is less risk inherently in the failure of the business due to all of the research that we know about business operations, right? Because it's more mature. And so there's going to be a lesser likelihood of failure. And this is talked about ad nauseum, honestly, in the book about the buy then build. That's the whole point, right? You're buying established businesses that have already hit certain milestones, like $1 million in sales. The other thing to think about is a $10,000 or a $10,000 error in a big company that's making 400, 500,000 in SE is substantially less impactful, right? So most people will have a greater appeal for the increased risk tolerance of larger deals. Before I talk about the kind of dissecting all of the different components about figuring out what you could afford, I just want to go over some commonly used terms. Keep in mind, I am not an accountant. I am not a finance expert. So I'm just going to kind of breeze through these, but I do want everyone on this call to understand the distinctions between some of these. So SDE, or seller discretionary earnings, is what we talk about most in this market, and what I'm going to use moving forward. And that's net income plus add backs. And so the important thing to note here that I just want to share, because I like helping, and this is a nugget, that's important to understand. It's the Wild West. There's no regulations for brokers. And so when you're looking at a listing and you're looking at add backs, sometimes I'm seeing a little more often than I would like to, where there's two owners, often a married couple or partners. Both of those owners are 30 to 40 hours a week. They're adding both of their salaries back. You cannot add both of those salaries back. You can add back one owner's compensation, including benefits, to SDE. The other one needs to remain an expense item because you're not two people and you can't be expected to replace two people with one. And so SDE includes an add back of the owner's salary. So your SDE is basically how much money you have at the end of the day to run the business with, right? After running the business. So, what can you pay yourself? What can you put in your cash reserves, and what can you pay taxes and those things with? Your net income is the most commonly used terms. I think everybody basically knows net income. It's your bottom line. EBITDA is, I'm seeing it used more in deals. It's typically a term used in larger deals, but it is trickling into this market. I'm seeing a little more often than not. That is going to be your net income added with interest, taxes, depreciation, and amortization added back. The final thing is actually the important part for you guys. If you're a searcher who is looking to be more of an advisor role and have hire an operator to run the business. And I emphasize the point of hire an operator, meaning there is not someone already there. You might want to think about looking at adjusted EBITDA for your own metrics. So adjusted EBITDA is going to be EBITDA plus add backs, which includes any overage of market rate of compensation of an owner. And so when you're looking at adjusted EBITDA, it will be a smaller number than SDE typically, but it will have already accounted for an operator being in place. And so that's something that you would need to think about as an acquisition entrepreneur that's looking to hire an operator. Only important if you're hiring an operator, right? If there's already an operator in place, they're going to be already as an expense under the SDE number. Okay, I know that's probably going to create more questions for you guys, but I just wanted to lay it out there. So let's dive into what can I afford, right? There are three questions, in my opinion, you should be asking yourself when it comes to figuring out what you can afford. The first thing is, how much capital are you or others contributing? The second thing is, are you trying to replace an income? And if so, what level? And then the third question is, how much post-close liquidity will you need? Post-close liquidity is one of the most glossed over topics in these calculations. And so I'll break it down in a minute. The first thing I want to talk about is the required capital contribution or down payment. I really wanted to provide you guys with some guidelines as far as how much you should plan on putting aside based on the deal size, but I always check myself with experts before I talk about anything, honestly, because I hate giving this information. It's a huge pet peeve of mine. And so I couldn't get them to agree to any kind of guidepost. And so what I can tell you is that traditional bank financing is going to be at least 20% down. SBA financing is going to be absolutely determined by cash flow of the business and historical performance. However, I think you should always plan for 10 to 20% down for a down payment. So in my experience, and this is Chelsea's experience, please don't, think that somebody else might agree to this, but I've seen 10% down for like $1.5 million deals. I start to see it creep up as the number reaches like 3 million to like 15% down. If a deal is like 5 million, it'll be like 20% down. Now keep in mind that number can be split between you and the seller. But at a minimum, you need to plan for 10% down. I also want to make sure that everyone understands that the 10% down sometimes will need to come from you as a human. There are situations where you're working with investors where it can come 100% from an investor. It can never come from debt. You can never fund your down payment from debt. But you can sometimes fund it from investors if they're accredited investors that have done transactions in the past, like a search type fund. Where I have gotten clarity recently from lenders is if you're looking for, and I did this for a prospect that I was talking to, if you're getting investors from families and friends, they might require a small portion of capital from you so that you have skin in the game, because they treat family and friends investors differently than accredited investors from a risk perspective. And so it's possible if you're thinking about using family and friends that you will also need a small amount of capital contributed from yourself. Also, like I kind of mentioned, as deal size increases, it's good for you to plan for the down payment to increase as well. Now, whether or not you decide to split that with a seller note is totally fine. And again, keep in mind, these guidelines will change by lender. Every lender has different requirements. Every business warrants different things. I've seen one $5 million deal with 10% down because it was cash flowing so well. And I've seen one deal that was not cash flowing and they would only loan up to 60% of what they needed. And the member had to close the 40% gap between him and the seller. So like, these are guidelines for building out models, but know that your best interest is always going to be to speak to a lender about what they can do.
Chelsea, can I hop in here with an audience question?
No. Yeah, of course.
So in this space, we're always talking about SBA. That's by far the most common. On the previous slide, on the previous slide, you did have the traditional bank financing column there. Sean is asking, is that difficult to get? I mean, is that going to be accessible to first-time acquisition entrepreneurs? What do you see there? Should people think about it or even consider it? Or is that just like kind of for wealthier, more sophisticated or more experienced folks?
No, we've had members that are actually, it's more appealing to get traditional bank financing because of the requirements of the SBA. And so you should definitely talk to your bankers about your options with traditional bank financing. Keep in mind too, this is not the only financing options. If you go on the Acquisition Lab YouTube website, it's the Buy Then Build YouTube website. We don't have one for the lab. There's a whole talk that I did with Bupos, who is a revenue-based lender. Mm-hmm. But keep in mind, any lender, there's another capital company that one of our members was trying to use for a transaction. They're all going to want you to have some skin in the game. And it's almost always at least 20% down, right? And so I just think if you're doing any modeling, you need a plan to have 10 to 20% down. Does that answer the question?
Yeah. Yep.
Okay. The next thing that I want to talk about is post-close liquidity, because it's really important, and I don't know why it's not talked about more, to be honest. Post-close liquidity, it is to some extent specific to SBA loans, I guess, but I've heard other lenders talk about it too, so I don't know that for a fact, right? And I couldn't confirm it before this call because I thought of it last night, but post-close liquidity is the amount of money you are required to have liquid post-close, right? And so think about it as like the safety net, right? The cushion in case something were to go wrong. And so what the lenders don't want to do, and I can imagine most lenders would approach it this way, but I just couldn't talk to a traditional lender yesterday to confirm. They just want to make sure you're not cleaning yourself out to do the deal and then you're left with nothing. They want to make sure that you have some liquidity. The level of liquidity will vary. And I think actually there's a clip of somebody talking about this on our YouTube channel too, but it will vary by industry. And so for a highly capital intensive business like manufacturing, or a company that requires like high inventory levels, they're going to require higher levels of liquidity for you. Because if something were to go wrong, you would need to be able to fund your money back into the business to continue operations. But if you were buying like an IT service firm that doesn't necessarily have high overhead other than just people, you may not have to have high liquidity, right? You could get as low as 3% liquidity at that point. And so it's best to talk to a lender. I can't say that enough early in your process to figure out exactly what your requirements would be for, and you could just give them a listing that's kind of interesting to you just to run through the process. By no means do I mean waste their time, but I understand that sometimes it's a chicken and egg thing for acquisition entrepreneurs. And so don't feel bad about doing what you have to do to get your answers. What I will tell you is that's part of the reason we require our members to go through the pre-qualification process, is because it is so nuanced. And I will also tell you many times they find out they can't buy as big as they thought they could. At least that was in the beginning of the lab. I don't hear it so much now, but in the beginning, it was a surprise to people because they were not accounting for post-close liquidity requirements. Okay, so I want to actually go through what this looks like in reality, right? And so here is a buyer profile. Someone's looking for a B2B service company between 250 and 500,000. They are like Bob. Bob, remember, he's the marketing automation guy. He's looking to do 90 and 10% down payment. So let's look at what this actually looks like. This deal is 1.5 million with an asking price of 450. I mean, with a cash flow is 450,000. So cash flow, just to be clear, is what a lot of listings will list SDE as. I don't know why everyone feels the need to use 35,000 different words for this, but that's seller discretionary earnings. Again, that is going to include all of your add backs, which is also really important for you to pay attention to, because they're adding back taxes, they're adding back health insurance. And so they add it back because it's a valuation strategy, right? It gets them more money, but that doesn't necessarily mean you should overlook it, because you will have to pay taxes, and there's a high likelihood that you also have to pay insurance. And so you'll want to account for that as well. And so if you're buying a business with debt, typically what you see as the SDE value is never going to be what you're paying yourself or what you have access to pay yourself with, right? So let's talk about what I mean by that. And so in this deal, you have $450,000 as SDE. The general rule of thumb that I give people on the strategy calls is to divide the SDE that's provided by 2. Full disclosure, that is a rough estimate, but it is pretty spot on for what we've seen. That number will change as interest rates increase and as your terms change. But if you're thinking about using 90% leverage, it takes a lot to pay that debt back, right? And so you want to divide that number by 2. Half of that is going to go towards debt service. So just set it aside in your mind. The other half then gets divided up into 3 categories. The first is, how are you funding your growth strategies? The second, how much do you need to pay yourself? And then the third is, how much do you have left over for like an operational cushion, which could be used to pay your taxes or to pay health insurance, whatever. Okay, so we're going to actually kind of run through what this looks like in the example I just gave you. Again, this is a marketing person. They got 300 grand saved up for a down payment. They need a replacement income of 100,000. So they're paying 1.5 for this business. Their SD is 450. The debt service for this is going to be $222,000. I will tell you, I financed in this scenario 1.6 million, even though the ask was 1.5. And I think that's important for you all to think about as well. Typically, the amount you finance is going to be higher than the purchase price because it includes your closing costs and all your fees. And something that I want to mention, and I think it's actually in my notes on one of the following slides, so I'll wait to mention it because I don't want to cite it incorrectly, but in this number of fees is your SBA guarantee fee if you use the SBA, and that is not a small number. And so I'm going to give you the calculation there on a future slide. The other thing I want to note on this is that the interest rate I use for this example is only 7%. And with the most recent changes, it went up to 7.5%. So just give you some grace there on the calculations, but it's directionally correct. And so as you're thinking through debt service, this is kind of the guide rails to operate within. As your multiple and interest rates decrease, your debt service is going to decrease. As your multiples and interest rates increase, your debt service is going to increase. And so I typically always see that debt service being 40 to 50% of your SDE, which is why I say just cut it in half, rather be conservative than not enough. And so let's keep going in here, right? So we funded 1.6 million because that includes all of our fees, including our SBA fee. He's going to set aside $100,000 for his growth strategies, right? So ads are expensive. That's my favorite thing when somebody tells me that they're going to run ads. We had a company that was spending $100,000 a month in ad spend to get to the levels that you guys are wanting to get to. And so don't underestimate how much your growth strategies are going to cost. He's set aside $10,000 to implement new tech solutions and $50,000 for hiring a new sales rep. That leaves him with $127,000. That's fine. He wants $100,000. He pays himself $100,000, and he has a $27,000 cushion. This deal feels doable to me for who he is as a human. So let's talk about the most common level of income I see when I'm talking to lab applicants. Will, do you have a question?
Yeah, Chelsea, let me hop in with a couple before you do another example. This is great. Going back to the post-close liquidity, can any of the working capital that's in the business that's negotiated, that or maybe a line of credit, anything related to kind of working capital in the business, can any of that be attributed to your post-close liquidity that the bank sees you as having?
I know I've been asked this question before, and I actually have the recorded answer in our commonly asked questions course. I'm not going to answer it because I don't remember. I'm dyslexic, so I'm probably going to tell you the wrong answer because that's how my brain works. But since it's in chat, I will email you the answer because I'll go check my thinking. My thinking is yes, but that means it's probably no. And so I don't want to mistake because I am not an SBA person.
Okay. Okay. Well, let me give you one other question because two people basically asked the same question.
Yeah.
Actually, on a recent Acquiring Minds episode, Clint Fiore, a business broker in Texas, was on, and he talked about the sweet spot for loan acquisition entrepreneurs being kind of 500 to 800K SDE, 500 to 800K SDE. Maybe you're going to answer this with your next example.
I will.
So yeah. So do you agree? How do you see that? Do you think that that's a good sweet spot? But maybe you're about to answer.
Let's talk about that next.
Let's talk about
it. All right. And I promise I will follow up on the other question. I hate giving misinformation, so I'd rather just delay the answer if that's okay. So let's talk about this. So the most common level of income that I hear from people needing to replace is 200,000. And so in this scenario, the same person, right, looking for 250 to 500,000 in SDE, let's do the math, right? If they're purchasing something for $850,000, I finance 950 just to bump it up a little for fees. And it's 132,000 in debt service. And I thought that I typed out the math, but I didn't. So I'm going to go ahead and just tell you guys. It's 3.5% on the first million and 3.75% on the remaining amount that you finance through the SBA. You can find this spelled out on their website too if you want to fact check me. But for this deal, I did the math and it's $50,000. And so that's not a small amount of money, right, that you're adding on to the purchase price. In addition to your closing costs and all that stuff. And so I just want to make sure that you guys are aware if you're doing the SBA that guarantee fee can be high, right? It's not just a little fee. And so that has to go into the amount you're financing. So work that into your models. So in this scenario, you would have $117,000 left over after debt service. Your growth strategies in this scenario, they're going to hire sales staff, one salesperson, 60 grand. They want to have at least 20,000 in the cushion for operating costs. That's only going to leave them $37,000 to pay themselves. Obviously, that is not enough. And so what I find people will do is they'll say that their SDE range is what they were making before. So if they were making 250, then their SDE range is 250. And so it's just, the whole point to me doing this call, if you remember nothing else that I'm telling you, it's you need to double whatever your requirements are, right? Because half of your SDE is going to go towards debt service at a minimum. You should also account for the other things I told you, but like bare minimum, double whatever you think you need because it's probably substantially more than that. So now to your question. Here's what I've seen work. So here is somebody looking for SDE between 6 and 750 in SDE. Same kind of background, sales and digital marketing, right? With this structure, they're going to need about $200,000 down because it's a $2.1 million purchase price, right? Keep in mind that can be split between seller financing and themselves, so it may not be that high. but the SDE level 700. Okay, I put in that they were financing 2.2 million. Again, do the math, and it's always smarter on models to err a little high than low. And so the subtotal after debt service for this is going to be $393,000 left over. They're setting aside $150,000 to run ads and hire a sales team, which is going to leave them with being able to pay themselves $200,000 in the replacement income and still have $43,000 in cushion. That is doable to me. So if you are trying to replace a $200,000 income, you need to be, in my opinion, the floor is $600,000. So if I were doing this, I would probably triple my needs because of the way that you have to cut up SDE for your growth strategies. If you are using high value growth strategies like sales, like ads, I would say that it needs to be closer to 750 or 800 to fund that growth appropriately. Does that answer your question, Will? Went right into it. I knew. I love that. Okay, so in summary, there are three things that you need to think about when you're determining what you can afford. The first thing is how much capital are you or others contributing. You need to plan for at least 10 to 20% of the purchase price. By planning for 10 to 20% of the purchase price, you cover yourself with that post-close liquidity as well. Because even if you only contribute 10 and get 10 from the seller, then you've had a little bit of cushion set aside. So I think I would plan for 20, even if I'm only putting in 10.
Chelsea, can I hop in right there? The seller financing, we certainly, my guess on acquiring minds, it's a very common feature of a loan. Is it kind of fair to assume that there will always be that I as the buyer will be able to negotiate 5 to 10% of the purchase price in seller financing? Can I just assume that, or is that a dangerous assumption?
I think it's a dangerous assumption, to be honest. I know that it's used a lot, but I think to assume, because I've also seen it not where the seller will not agree to it. I think that there are times when seller financing is 100% appropriate and required. But I think, again, in order to ensure that you can achieve what you're trying to achieve, it needs to be built where you don't need it, right? So then you can get it and it's not, so that if you get into the situation, like we had a member who went the opposite way. So he was under negotiation for a $7 million deal. He assumed he'd be able to cover the gap with seller financing, and it almost tanked the deal. He got them to agree because he wasn't going to close. But it's like, I personally, I mean, it was $50,000 in fees at that point. I would be hesitant to make that assumption. I think it's safe to assume, there may be a small percentage, but I would always plan, but I'm a planner. It's who I am as a human, for there not to be, just because I'd want to make sure that I was okay being able to say, like, I'm not going to ask you for seller finance, because you also have to be competitive with your offer, right?
Yeah.
And adding seller financing afterwards because the bank is asking you to do it is 100% okay, right? And being able to go to them and say, I'm giving you this amount of money at closing, you have a much higher likelihood of being taken as an offer than them seeing up front that you want seller financing if somebody else is saying they don't. By no means am I saying hide it. If you know you want it, don't hide it. Mm-hmm. But more often than not, your lender will actually ask you for them to put some skin in the game. And so it's easier to come back and say, hey, the lender is requiring 5% seller financing or 10% seller financing, because you do need to think about being competitive with your offers.
Great.
I don't know if I really answered your question.
You did. No, absolutely. But a follow-up here. Cameron asks, isn't seller financing pretty tricky with SBA loans? And to what you just said, basically a lot of lenders like to see it. I think maybe Cameron might be thinking about like 100% seller finance, some kind of like no money down type situation. But answer that,
yeah.
Cameron.
So that is a common thing that's said to me on sales calls, that SBA doesn't like seller financing. So it's out there, someone saying it. That's not my experience. What I will tell you is seller financing has to have very specific terms. If that's what they mean by tricky, that's true. But I can't really think of a deal where there wasn't some component of seller financing, right? The thing that you want to think about is seller financing is a great risk mitigation tool. And in my opinion, I would much rather keep seller financing in my back pocket as a risk mitigation strategy than as a funding strategy, if that makes sense.
Yeah.
right? And so, yes, there's almost always seller financing involved in deals, but it's because it's a risk mitigation strategy that's more of a forgivable seller note. Whereas if the business doesn't do whatever that big piece of risk is, then the seller note gets forgiven. But
and mhm.
I think it's possible that people mean that SBA is tricky with seller financing because the seller note is always going to be secondary to the SBA loan. And so like they're not going to look kindly on you if you're paying the seller and not them. But if you pay them on time and you've got all of that good, then most of the time it's fine. I've only seen one deal where the seller note was on full standby, where it couldn't be paid until after the SBA loan was paid off. And that's because the business couldn't handle the debt service with a seller note included. It didn't have enough cash flow.
Okay. So full standby is when the seller note is completely, it can't even be, none of it can be paid until the entire SBA loan is paid down. That's quite uncommon. The other thing, but you know, Cameron's we're going back and forth in the chat here a little bit. There are other like the SBA is actually very strict about seller involvement, going forward involvement in the business. They cannot retain a piece of equity. There can be no performance-based earnouts or anything like that. So maybe Cameron, some of that is what you're thinking. So it's very, very strict about that stuff. But yeah, I don't know if you care to elaborate, Chelsea.
Sorry, I don't know what you guys are talking about because I'm not following the chat.
Well, don't worry about the chat, but just talk a little bit about what is not permitted in terms of seller involvement after the acquisition, like retaining a piece of equity or having some earnout or performance-based payout.
Yeah, so the SBA has, and we go through a lot of this in the lab, right? But they do have strict requirements as far as like you said, how engaged the seller can be. They cannot be involved in the business for more than 12 months. They cannot retain any equity. SBA has to be used for full buyouts. Unless you're already a partner, you can use the SBA to fund your own, buyout strategies. I mean, the SBA has guidelines as government. I don't know what to tell everybody. Like there's a lot of, restrictions, which is why I say sometimes commercial financing is actually more appealing because people don't want to worry about all the requirements. Is that helpful? Okay.
That's great. Yeah. Thanks. Let's carry on.
No problem. And I will tell you, the SBA, there is a lot of nuance there, which is why we have an entire session Q&A and a whole course there's 72 questions in there right now about SBA financing. And so it's a heavy focus within the lab that our members are as informed as possible about the SBA. I literally have 200 questions in that course right now. And so there's a lot of nuance there. But it's a good program if you can take advantage of it, right? If it's right for your strategies. The second thing, just to summarize, is are you trying to replace an income? And if so, keep in mind that half of the SDE amount is what is going to be left after debt service. Again, I would triple whatever income you're trying to replace and assume that's the level of SCE you're needing. How much post-close liquidity you're going to need. I feel like you can cover that if you assume a 20% down payment, because then you'd have post-close liquidity if you only put 10 down, assuming that you still have some funds set aside to pay professional service fees that have to be paid prior to close. But yeah, it ranges from 3 to 15%.
Chelsea, another question on costs. So we've talked about costs related to closing costs, essentially, and SBA fee costs and so on. Are you including in that just deal costs like due diligence and broken deal costs? So you hear about that a lot, where somebody goes down the path on a particular deal and spends some money trying to get that deal done. Attorneys, accountants, due diligence, deal falls apart. And so if you're not, you're shaking your head. If you're not, can you kind of tell people what they might need to also have in terms of capital to expect there's probably going to be a broken deal or two before they get across the finish line?
I really wish I could, but I don't know that I can, because the cost varies so significantly with deal size. But like I said, the amount, so when you're coming to me, right, and we're talking about your acquisition strategy, if you're giving me all of your available money as your down payment, you should not be, right? You need to figure out how much money you want to put as a down payment. You need to figure out how much you're going to have as a cushion to fall back on, and you need to have money set aside to pay professional fees. Some people are willing to roll their fees into closing, but it's not often. And so I would assume, again, it's I hate giving guideposts for this because it's so nuanced, but like most people, unless you choose to go like super light on like your legal fees and your due diligence, like I think the cheapest I've seen talked about in the lab is like, and this was cheap, and I don't know that it's not a recommendation because it's really cheap, and the professional service fees is not where you should be saving money in your transaction, right? Because it's risk mitigation by choosing the right partners. But I would personally plan for 10 grand in legal fees. But there are companies now that are becoming more transparent with their pricing. And they're doing more flat rate pricing. And so you can go and kind of look to see how much they're going to charge for a deal, based on your deal size, because it is going to be based on your deal size. Like one of our members that is doing a $5 million deal has spent $50,000 in fees, right? Like legal fees, due diligence fees, things like that. We have a member right now that's looking at it's the smallest deal I've ever seen in the lab. It's like, I don't know, it's even smaller than like the threshold to get funding, which I'm trying to work with them through right now. And the estimate that that the lawyer gave him was 8 grand. He's like, 8 grand seems really high for a $350,000 deal. I'm like, it is, and you probably don't need that. And so it's really dependent on what your deal size is. But I would plan for at least 10,000 in legal fees for a small deal. I will say quality of earnings are not always required, but if you choose to do one, they're 25 grand at kind of minimum. You can get a quality of earnings light for like 15 grand. But all this is, you guys can find all this on websites, right? By looking at the providers. Most people have their fees listed. If there's the other thing to think about is make sure that your lender, like that you're clear on what the fees are at closing. Because that SBA fee, I feel like sneaks up on people. And like I said, for an $800,000 deal, I think that's the one I did the math on last night. It's 50 grand. And so as you can imagine, on a $2 million deal, it's 100, maybe 125,000. And so that's a substantial amount, and it gets added to your loan package. The other thing to think about is working capital a lot of times is included in your loan package. And so it's an additional thing that's rolled up. And so that's why that purchase price can creep up quite a bit. I think that's it.
Great. Chelsea, I want to get in. Somebody has a question about kind of related to the lab itself, the acquisition lab. You mentioned earlier in the call that there's you pre-qualify folks to get to work in the lab or participate in the lab. Can you kind of elaborate on what you meant there? And because Nicole asks, like, how do you have participants or members pre-qualify when they don't have a business yet? It's just, if you could just clarify.
Yeah, and I think there's a misperception, and I don't want to go into too much, but this is why people should join the lab. And so there are 2 components to using SBA financing. There is getting qualified as a buyer, and then there's getting qualified as a business. And for whatever reason, some lenders are unwilling to talk to you without a deal in hand, and some lenders are willing to talk to you prior. And so I would encourage you to find lenders that are willing to talk to you prior. We have all of our members go through a process. Keep in mind that the bulk of the lab is designed in the very beginning, right, prior to the hand-holding of the advisory service, is built to define a brand for you. Part of that brand is a pre-approval letter. And so they're looking at your personal financial statement. They're looking at your kind of bankability as a buyer for the type of business you're trying to buy. And they put you through kind of their process to say, yes, we would fund you up to $2 million. Right. And they'll tell you how much post-close liquidity, they would expect you to have and how much of a down payment they would expect you to have. It's one of the reasons why we do it, is because it helps our members, come off as stronger investors in the market, but it also makes sure that they're being very informed in their search. I can't tell you how many times I tell our members to reach out to their lending partner and have a conversation about listings prior to LOI. And so it's a really valuable experience, but some lenders, I will tell you, the reason we use the partner that we use is because we really value their letter. There's a level of specificity to it that is really helpful for people. Whereas other lenders will give you a letter that just says, like, we're willing to support this person in an acquisition. There's no specifics given. Is that helpful?
Mm-hmm. So to be clear, members of the lab come out of the other side of the lab with pre-approval by a really reputable SBA lender,
Yeah,
which makes them a stronger buyer out in the market. And oh, by the way, it also tells them that they're actually able to do a deal.
yeah, that paired with the buyer profile that our advisor creates with you is really the bulk of your buyer branding packet that you use to do outreach. It just helps, like our members have offers taken over private equity. We have members that are offered jobs as brokers. Like our members come off very informed, which is why we do what we do. But that's really the culmination of the intensive. So the first 4 weeks of joining the lab, we put you through an intensive to get you ready to go to market. And that's the culmination of it.
Yeah.
Now,
it's really,
let me be clear. We're not requiring you to work with that lender though. We just use them for the pre-qual process. If you want to work with them, that's fine. But you should definitely be picky about your lender.
Mm-hmm. Great. We're at 10:50, everybody. So we only have time for another question or two. And I'm looking at all the questions that have come in. A reminder that Chelsea will do her best to answer some of these relevant questions after the fact and send them out to you one way or another. Chelsea, but I assume with this slide, was there anything more into your presentation, or can we just see how many questions we can fit in here in the next 5 or 6 minutes? Okay. Home equity lines, how can or can they be used to for your down payment capital? Or does the SBA accept that, or what?
It's tricky, but my understanding is yes, as long as there's an income stream that can pay down that debt.
And an income stream not coming from the business?
Correct. It cannot come from the business. It has to come from like a spouse or a side hustle or you having full-time employment. It cannot be paid down by the business. It cannot be debt service on top of the SBA debt service. So as you think about funding your deals, guys, like think about it logically, right? You can't add debt on top of debt, right? Because the business can barely hold the 90% financing. It can't also, that's why they're picky about the terms of a seller note, right? Because the seller note is additional debt. And so it all works out to how much debt the business can handle and still operate and grow and do the things that you're trying to do.
And so do you see, I assume you don't see home equity lines very commonly then? You do.
Yeah, we do.
Okay. So it's not uncommon.
It's just that
it's tricky,
typically
but not uncommon.
And it's not even tricky as long as their spouse has a job, which is what we see most often, right? Or if they have a job and they're still going to be working, it's fine.
Okay. Great. Rob's rollover for business startup, the 401k program, the program that allows funding a deal from your 401k. The lab actually just had a speaker about that a few weeks ago. I went to that session, but I'm going to let you answer this question, Chelsea. So talk to people about Rob's, please.
That is a really, really big question. Rob's is a strategy you can use to buy a business. I will say that it's a lot more nuanced than I was aware of until I brought that person in to speak to the lab. It is 100% reasonable strategy. It's used by many lab members, but I will really encourage you to get informed whether that if you join the lab, you should watch the talk. If you don't join the lab, you should talk to somebody and really get granular on what it means, what the flow. I guess my only nugget that I can give you is like, make sure you're clear on what the flow of income looks like if you fund with a Rob's.
The flow of income.
Yep. Because that SDE number may not look like you think it looks if you fund with a Rob's. That was my takeaway, Will. And you can tell me if you had the same takeaway on that call.
Yeah. Okay. I'm hopping through a bunch of these questions. It's a bit disjointed, but I want to get to as many of them as we can. The SDE, the sweet spot, 500 to 800K, let's call it, as Clint Fiore said in the interview, and as you've kind of agreed with here. Does that vary at all by industry? So I'm thinking about e-commerce in particular. So like on Quiet Light, for example, where Walker Deibel's a broker, you'll see a lot of e-commerce businesses that seem like great kind of side hustles or even just one-person businesses. And because they don't have like a lot of, they maybe have no employees, it seems like you could allow yourself a smaller SDE to get into that business, like a 300 or 400,000 SDE, because you're just not going to have, you don't have employees generally. So the expenses to run that business seem less, and therefore you could allow yourself a bit of less SDE and get comfortable with that. Do you agree
No.
with that direction? Okay.
No,
Great.
because e-commerce businesses rely heavily on ads. Ads are very expensive. And so for some reason, everybody thinks that, but if you're looking to grow, those growth strategies, again, coming from SDE, are very expensive. And so again, it's just the same math, right? You cut the SD in half, see if it can serve the debt, see if it can fund your growth strategy, see if it has enough cushion. You're right in that it will require less of a cushion probably because the overhead is smaller. But you need, like we have a member right now who her target was the one that the broker and I agreed to, right? That sweet spot. She bought a smaller deal because she could very clearly double it in size. But all of the SDE is going to have to go towards funding that growth. And so that there's a risk there. But she is very confident in her ability to grow it. And so the challenge with e-commerce is it looks like a very simple business, but if it's relying on ads and marketing strategies, those
very
are expensive.
Yeah, great point. Great. Let's call it there, Chelsea. We're at 56. I want to thank everybody for coming. This was very meaty as expected. Great examples, great presentation, Chelsea. There, everybody, you can see on the slide how to get in touch with Chelsea for if you want to talk about the lab, Chelsea at buythenbuild.com. And then, of course, watch your email. We'll get this presentation out one way or the other in the next few days. And again, Chelsea, we'll see about all these other questions that came in that unfortunately we didn't have time to answer.
Sorry,
Chelsea,
guys.
thank you. Thank you very much for doing this, Chelsea. This was great.
My pleasure.
You all very much for coming. And this concludes the event.
Bye, everybody. Have a good day.